What is Profit First, and how do you use it in your author business to smooth out all that seasonal revenue, scale sustainably, prepare for taxes, and actually start paying yourself? This is going to be a two-parter because there's a lot to cover. So in the first part, we're going to go over just the basics of Profit First. And then in the second part, we're going to go over some advanced strategies specifically for authors trying to scale. Make sure to watch for part 2 and subscribe to make sure that you get notified. Profit First is from this book by Mike Michalowicz, and it's essentially just a cash flow management system. Here's the problem. Whenever you have an expense come up, like your cover design or your editing, what do? Do you look at your P&L or your balance sheet or cash flow statement to figure out if you have enough money to pay something? No, instead, we look at our online banking mobile app, we see if there's money there, and if there is, we spend it, and if there's no money there, we panic, we find money, and then we spend it. The reason for this is something called the Pareto principle, which originally I think was talking about how tasks will fill up whatever time you give to it. In the same way, our expenses are going to expand to fill up whatever money we have available. So if we're going to do this bank balance accounting, we have to try to trick ourselves into thinking that we have less money than we really have. I remember as a kid, my mom would balance her checkbook like people used to do. And she told me that she always put in her checkbook less money than she actually had. Like she might put $500 less. And so whenever she got to zero in her checkbook, she knew she actually had $500 in the bank. And that was her way of making sure she didn't spend that $500. This is kind of the same thing, but we're going to be a little bit more sophisticated about it and do it specifically for your business. So to use Profit First, we're actually going to set up a bunch of bank accounts and move money to different accounts based on percentages that we set up ahead of time. In part 2, I'm going to go over some extra accounts that you might need for your author business, but in this part, I'm just going to go over the 5 core accounts that are outlined in the book in the basic implementation of Profit First. The 5 accounts that you need to have set up are an income account, a profit account, an owner's pay account, a tax account, and an operating expense account, or OPEX. And let me walk through what each one of these is for. The income account is kind of like your serving tray. It's a holding plate. It's where all the money is going to come into in your business before you allocate it out to different areas. So this is where all your book sales, royalties, and any other money coming into your business is going to be deposited into. And we're going to use this account to transfer those funds out to the other accounts based on our percentages so that the income account should get to zero every time we do this. The next account is your profit account. Now this might sound weird, but you're actually going to set aside profit. Traditionally, we think of profit as whatever's left over after you spent all your money. The normal way of doing things is to get to the end of the year, look backwards and say, I wonder if I had a profit. And then say, shucks, I didn't have one, I spent everything. Instead, what if we just take a certain percentage of our revenue, put it in a bank account, and never touch it? Then by default, you have to be profitable. Because the thing is, profit isn't an event. It's not something that happens to you. Profit is a habit. It's something you do. You have to stop thinking of profit as a noun and start thinking of it as a verb. Now that profit money is going to grow. We're not just going to let it sit there and do nothing with it. What we're going to do is once a quarter, you're going to take whatever's in that profit account, pull out half of it as a dividend or a profit distribution for yourself. It's the same way as if you own like Coca-Cola stock and they paid out dividends. This is your reward for the risk that you've put into this business. Use this to reward yourself. Don't use it to just buy groceries. Use it to buy a special bottle of wine or do something fun. Even if it's just a small reward, it's the act of rewarding yourself for a job well done in your business that's important. Now, if you have debt in your business, we are going to recommend using a large portion of that distribution to pay down some debt, but we still want you to reward yourself. The next account is your owner's pay account. This is my favorite account because this is the one that you can actually use to make a difference in your life and make a difference in your family's budget. Now, whenever I was doing Profit First the wrong way, I didn't have a separate owner's pay account. I just had my personal checking account, and whatever my owner's pay percentage was, I would just deposit into my personal checking account. The problem with that is whenever it's busy season and the money is good, I have more money to spend, and so I spend it. And then whenever it's the slow season and money is not so good, then I have to figure out how to pay the bills. So having a separate owner's pay account within your business is really important to be able to smooth out your owner's pay throughout the year. And the way you do that is the money that's going into the owner's pay account, it's going to be a different amount every single month because it's going to be a percentage of your income, and your income is going to change every month. But the money you pull out of the owner's pay account is going to be a set amount that you figure out based on how much you need the business to support your personal life and based on how much income you're earning in your business. So let's say that number is $5,000. You might put into the owner's pay account $7,500 one month, but you still pull out $5,000. You leave the other $2,500. The next month, let's say you have another $7,500. You put that $7,500 in, you still pull out $5,000, leaving that $2,500. Now the remaining balance in the owner's pay account is still $5,000. So the next month, if you have a short month where you can only put into the account $4,000, you can still pull out the same $5,000 every month. Now, it gets really frustrating whenever you first start doing this because it almost never works out to where the timing is right. A lot of times people are implementing this during slow seasons, and so it's hard to have that excess. But if you just keep at it long enough, then it eventually smooths out and gets to the point where you can pull a consistent amount out every single month. Next is taxes. And if this is the only thing you do, you'll feel so prepared. You need to be setting money aside for taxes. With the W-2, you have taxes being withheld all year long. But with your business, you're going the entire year without paying any taxes. And that's why when you file your tax return, you end up with this big tax bill. So you need to be setting money aside every month for what you think you might owe in taxes. Now, I don't expect you to figure out all your deductions and what's taxable and what's not taxable and figure out what your taxes actually would be. So we're just going to have you set aside a flat percentage of your revenue every month before any expenses when you calculate how much to set aside for taxes. Then at the end of the year, if you owe money, you have the money there to pay it. And if you don't owe anything or you don't owe as much as you set aside, then you get to give yourself a refund instead of waiting for the IRS to give you one. If you need to make quarterly estimated payments, then this is the account that you would make those estimated payments out of. Finally, the last account is your operating expense or your OPEX account. This is where all of your other expenses are going to come out of. These are the expenses that you need to use to run your business. So whenever you get that invoice come in and you need to make a payment or you need to pay a bill, this is the account that you look at to see if you have enough money to be able to pay it. So how much do we actually set aside in each account? We have these percentages, and the percentages are going to be based on how much real revenue you have. What's real revenue and how's that different from total revenue? Total revenue is everything you bring in whenever you sell something. But real revenue would be what's left over after you actually fulfill the sale. So for an author, if you sell a physical book, you have to replace that inventory at some point. And so your real revenue wouldn't be what you got from the customer. Your real revenue would be what you got from the customer minus what it's going to cost you to replace that book. If you had total sales of $100,000, but it cost you $25,000 to replace the inventory that you sold, then we're going to treat your real revenue as the difference of $75,000. And that's the number we're going to use to figure out which percentages you're using. That's also the number that we're going to use to base these percentages on. For example, if your real revenue is between $0 and $250,000, then we're going to use that first column where your profit percentage is 5%, your tax percentage is 15%, your owner's pay percentage is 50%, and your operating expense percentage is 30%. In the example where we had $100,000 of total revenue, but $75,000 of real revenue, we're going to apply each of those percentages to the $75,000. For profit, we'll take 5% of $75,000. For owner's pay, we'll take 50% of $75,000, and so on, rather than using the $100,000. Now, whenever you get started with this, you might say, well, I'm not setting anything aside for taxes or for profit, or I'm not paying myself anything and my operating expenses are 90% of my revenue. How do I go from 90% to 30%? And the answer is you do it in baby steps. In the very beginning, all you have to do is get the account set up and then just change where you are now by like 1%. And just do that for a couple of months. Get into the habit of allocating things. Get into the habit of moving money. If your business can live on 90% of your revenue, then your business can live on 89% of your revenue too. Maybe whenever you started out, you had 10% going to tax, nothing going to profit, nothing going to owner's pay, and 90% going to operating expenses. In that first month, you might start doing 1% to profit, leave 10% in tax, keep doing owner's pay at 0 if you want, and then move your operating expense down to 89%. This is going to force you to try and find where that 1% is going to come from to cut that expense. And once you get good at it, and once you start seeing how this works, then you can start making bigger jumps. Maybe then you can go to 11% tax and 3% profit and 2% owner's pay and the difference into operating expenses. See how that feels, adjust, and then move forward again. Doing that enough times over and over, you're going to see how quickly you'll actually get to where you need to go, because something interesting happens. Whenever you start becoming really intentional about the expenses that you keep in your business, you start only keeping those expenses that really move your business forward. So not only are you going to see your expenses shrink, you're going to see your revenue start to increase more than it was before. And as your revenue increases, that means a bigger pie to work with to where those percentages are actually easier to hit. So that's it for part 1. Stay tuned for part 2. We're going to go over some special accounts that you need specifically for authors. like how to handle inventory and ad spend and publishing costs. We're also going to talk about managing debt in your business and how to handle your debt while still planning for the future. Make sure to check that out whenever it comes out. And if you want to get notified, click subscribe, and I will see you next time.